Ever since the merger, Warner Bros. Discovery has performed horrible. Stock is now at $8 per share and with only a market cap of $21 billion. However, there still is a lot of free cash in this company, so let's look into it if this company is a buy. They have 3 different business segments: studios, networks, and direct to consumer. Their studio segment produces movies, distributes them in theaters, on its own networks, and licenses them out to others. Didn't have a great year, 19% decline in revenues. While the cost of production has also been going down, their selling general administrative has gone up quite a lot. This is one of the legacy businesses. Their second legacy business is the network segment, which contains a lot of TV channels all over the world. CNN, Eurosport, Discovery, all of that. We can see total revenues, slight decline, 9%. Linear TV is just a declining business over time. They had some slight one-off time this year, for example an exit from AT&T Sportsnet. That was a 1% decline in revenue. It is not a fastly deteriorating business, but it is slowly shrinking over time. Now the direct-to-consumer business is their growing segment. They're not fast growing here, total revenues grow by 3%. They were unprofitable last quarter, however the profitability is increasing fast here. The content revenue is very small here. In this case, it just depends on when the third-party licenses happen. It's a very small segment of the business. The growth rate would have been slightly higher without that. However, as subscribers developing, total subscribers did grow year over year, while significantly raising prices by 50 cents on average. The US segment has shrunken a lot, but internationally they have grown very, very fast. And especially here they have raised the prices a lot, which I really like to see. Now what is the overview I get just from looking at the business segments though? It reminds me a lot of Disney. 2 legacy businesses which are not performing well, a growing direct-to-consumer business which is slowly turning profitable. This is basically another Disney. Now their free cash flow has grown quite a lot last quarter, 33% year over year. However, that is mostly due to the SAG-AFTRA strike. Because less was spent on production during that time, their free cash flow has been much higher. I wouldn't take this as a new baseline, but it is not like the company is in a fast decline. Over time they're still slightly growing. Warner Bros. Produces a lot of fantastic movies in my opinion. However, they have the 2 legacy businesses. The studio business is a bit more resilient in my opinion, even in theaters. Going to a theater is way different than just watching something at home. It's just a different kind of experience. That's like saying Las Vegas is gonna go bankrupt because of online casinos. However, of course, they're being pressured here, and especially the linear TV business is gonna be in a perpetual decline. Direct to consumer, slight improvements over time. However, I don't think this company is gonna be a fast grower anytime soon. Maybe they're gonna grow revenue by 2 to 3% over time. After the merger, Warner Bros. Discovery was left with $50 billion of net debt, and they have been rapidly paying this down. In 1 year, they have paid down around $7 billion of net debt, and repaying that debt is not too much of an issue when it comes to maturity. We can see their maturities are fairly even, and 100% of their debt is at a fixed rate. So they're gonna just be able to pay off that debt each year when it matures. They're using most of their cash to pay down debt. That leaves them with less to invest, and they're not gonna be fast growing until that debt is paid down and they're able to do more acquisitions or do more movies. So you're not gonna have a fast grower until a lot of his debt is paid down. But if they continue to pay around $6 billion of debt per year, in 2 to 3 years, this company is not gonna be that highly leveraged anymore. Currently it is, but in 2 to 3 years, not anymore. And then maybe we're gonna see revenue continue to grow again. They have had a slight growth in the time since the acquisition. They're not in crisis mode. However, to go back into growth mode, they need to pay down that debt. The dilution is also not that bad. You have some share-based compensation, but it is not too bad. The negative net income right now is just due to write-offs. The free cash flow shows that the company is still producing a lot of cash, and their gross margins are improving again. And so are their free cash flow margins. In the last 12 months, they made around $2.5 in free cash flow per share. Let's count with 2, just to be conservative. They had the one-off due to the writer strike that made their free cash flow artificially higher, and the company still has a few risky businesses. So let's go with $2 in free cash flow per share. Now let's think how the company is gonna grow. I would say for the next 5 years, it's probably only gonna grow around 2% per year. It has the slowly declining network business. The studio business is gonna have a slight improvement again. I think that had a very rock bottom year this time. And direct to consumer is still growing and shows no sign of slowing down really. During those 5 years, they're gonna pay down a lot of debt, so they're not gonna pay out the dividend. And if they would really just pay down debt for 5 years, they would be nearly debt free at the end. So I think at that point they would be able to pay out a lot. Let's say they start buying back shares afterwards maybe. Or they're gonna invest more in the company, do some acquisitions, produce more content, so they're gonna grow faster. Well, 2% higher growth rate, 4%, plus 40% payout ratio of their free cash flow with a little deduction due to taxes. Now what would be an appropriate multiple for this stock? Since it's a fairly risky stock, due to it not really growing right now and having some legacy media businesses, let's take a conservative multiple of 12. That would give us an intrinsic value of $14 per share. Currently it's trading at $8.80, that is a 60% discount. So under these assumptions you make a decent amount of money. Now what if it goes a bit better, just a tiny bit better, 1% higher growth rate and a better multiple because they're gonna grow faster. $18 per share. Now, what if it's gonna go bad for the company though? Only 2% growth rate, maybe their legacy media businesses decline worse than thought, and instead of paying out the dividend, they just buy back the shares to keep the level kinda equal. 10 multiple, because it wouldn't be a good business at that point. But even here, you still make 10% return with these calculations. Is Discovery a buy? For me, yes. It's not gonna be a big part of my portfolio. I'm gonna make it a tiny position of my portfolio. If it declines even further, I will increase the position. But it will never be a big position in my portfolio. I'm willing to take this risk because the return is worth it here. What do you think about Discovery? Write it down below. Have a good day.